In investment, few things are certain about the future. In investment, there are very few things that investors can be certain about regarding the future. The uncertainty of the market's future will always be a constant that never changes. Confidence can be a good quality in other fields, but unfortunately, it often buries countless inexperienced investors who are overly confident in themselves. For seasoned investors, the almost insane confidence of new investors always feels intriguing. It reminds them of the early days when they themselves were just beginning to participate in the stock market. They too once felt the thrill of adventure until the market, like a strict principle, administered rigorous tests. In investment, as in life, there are very few things we can be completely certain of. Success never has a shortcut, beating the market has no formula, and nothing lasts forever. However, if the author had to identify a market variable that we can confidently assert as unchanging, it would be the cyclical nature of the market. As the renowned investor Howard Marks once remarked in his book, "The most important thing, the more time I spend in the investment world, the more I appreciate the value of cycles in the market. When the market rises to high, it inevitably must fall. When it falls to low, it must recover." In other words, the market moves like a pendulum, and when the pendulum swings in one direction for long enough, it generates enough momentum for a reversal. Two opposite extremes, the existence of cycles in the market is fundamentally due to the presence of emotions in investing. In fields where emotions do not exist, confidence in the certainty of the future is entirely justified. For example, mechanical machines always operate predictably if we understand their operating principles. However, in any field where humans play a crucial role, results are always diverse and cyclical, or in other words, unpredictable. We have never been purely rational beings, despite what economics often assumes. The market is essentially a marketplace, a gathering of buyers and sellers conducting transactions with one another. It can be said that the market's fluctuations from peak to trough are driven by two completely opposing emotions, greed and fear. Greed and fear change rapidly, entirely dependent on investors' expectations for the future. A bright future outlook is the perfect catalyst for greedy behavior, while a bleak future scenario is the perfect breeding ground for fear to dominate. Just like a marketplace, a company's stock price will increase when demand exceeds supply. The number of buyers will continue to rise as more people believe in the company's bright future prospects. This will continue until expectations no longer match reality, and bubbles always form when there is a gap between expectations and reality. Bubbles will continue to inflate as more investors become confused between illusion and reality. Eventually, the inevitable will happen. When the time bomb explodes, the market will plummet with a common expectation of a disastrous future. Of course, this explanation leaves out many important specific details, but overall, it fully illustrates the main points of the market's cyclical fluctuations. In other words, the market moves like a pendulum, with movements toward extremes, providing the impetus for the market to swing back. The upward movement toward the peak generates increasing momentum for the market to collapse, and the downward movement toward the trough generates increasing momentum for the market to recover. The cyclical nature of the market is unchanging, as history has always proven. Nothing lasts forever. In the famous series Game of Thrones, there is a scene where Jon Snow and Daenerys Targaryen are walking together at Winterfell, while atop the walls, Davos, Varys, and Tyrion engage in an interesting conversation about their powerful queen. Tyrion, they make a lovely couple, don't they? Varys, you're overestimating our influence. Jon and Daenerys don't want to hear advice from old men. Tyrion, I'm not that old, and our queen highly respects the wisdom that comes with age. Varys, of course. Respect is how the younger generation keeps their distance from us, which is why we don't want to remind them of a harsh truth. Tyrion, what is that truth? Varys, nothing lasts forever. Varys understands that nothing certain exists in life, just as Jon and Daenerys' feelings for each other may not last forever. Therefore, a general rule of life is that nothing can last forever, and the trends in the stock market are no exception. Companies that perform well during good economic times will decide to heavily invest in production capacity to capitalize on growth trends. These investments become cost burdens that hinder the business when the economy declines. Banks will expand lending frequency with attractive interest rates, even lending to customers with unreliable credit scores during economic growth, and then become extremely cautious with loans when the economy worsens. Investors during market booms will always overvalue companies, while investors during market crises will always undervalue companies. An endless loop of economic cycles. In the market, nothing develops as steadily as a straight line in a mathematical graph. Everything develops steadily for a while, then collapses, after which everything becomes a disaster in an instant. Prolonged disasters cause most people to forget that a turnaround always follows a storm. An economic newspaper once published a famous headline stating, "The worst bad loans always come during the best economic times." Similarly, the riskiest investments always occur during the most euphoric market phases. The economy will always expand and contract in an intertwined manner as consumer buying behaviors are entirely driven by emotions. Therefore, no economic trend can continue indefinitely without an endpoint. Echoing the famous economic saying, "What can't last forever will eventually come to an end." However, every decade, a group of new generation investors decide that the cyclical nature of the market is an outdated concept. They believe that a bright future outlook will last forever, or a bleak future scenario will have no end. When a trend continues long enough, it creates the illusion that this trend will persist indefinitely. But history has proven that the market always bursts when good times last long enough, such as the 2000 tech bubble and the 2008 financial bubble, and always recovers when dark times must end. The recovery period from 2001 to 2000 for after the tech bubble burst, followed by the formation of the 2008 financial bubble, and then the market's impressive recovery post-2009. Investors can confidently predict that when the market rises too long, it will eventually have to fall, and when a nightmare scenario persists long enough, a turnaround will appear. However, the timing and intensity of these reversals are impossible to predict. Experienced investors who understand financial history always know that cycles will occur, and they also know that investment opportunities become increasingly attractive as more people overlook this important concept. But they are wise enough to understand that timing the market is always the most challenging puzzle, a dangerous gamble that can bring an indescribable sense of joy when executed correctly. Success always bears the seeds of failure. The development of a trend will inherently create the momentum for its reversal. Every party will come to an end, and after every storm, a turnaround will always appear. As the famous investor Howard Marks once noted, success always brings the seeds of failure, and naturally, failure always brings the seeds of a new, hopeful beginning. If cycles are entirely driven by emotions, what causes the shift in investment behavior from greed to fear? Why do euphoria and gloom continuously alternate their positions in the market? The answer lies in how investors perceive risk in the market. When greed sweeps the market, most investors feel that risk does not exist. They believe they cannot lose money no matter where they invest, and this indeed happens for a certain period. This reinforces investors' greedy mentality, leading them to make riskier decisions in pursuit of profits because this is how they have made substantial money in the past. The more euphoric the market, the more risk accumulates until the market can no longer sustain this euphoria and begins the reversal process. At this point, investors with the highest risk portfolios suffer the largest account value declines, making them the ones most willing to sell all assets regardless of the market price. When fear dominates, the speed of sell-offs by investors intensifies, creating a self-reinforcing panic loop across the market. Instead of feeling that risk does not exist as in the euphoric phase, investors now see risk everywhere. They believe the risk is too great to invest profitably and therefore decide never to invest, no matter how attractive market prices may be. Consequently, most investors think the best approach is to stay out and wait until conditions stabilize. However, By the time investors feel comfortable to reinvest, the best opportunities have already disappeared. The change in risk perception in the market is always linked to the emotions that greed and fear evoke. This process is entirely subjective from the investor's perspective, creating an endless market cycle loop simply because humans always act emotionally in investing. The above explanation is an oversimplification by the author. In reality, there are many complexities and important details that only practical experience can provide. However, overall, this generalization still adequately describes the important points investors need to note. Always remember that knowledge alone can never fully its potential without the aid of experience. To succeed in the market, the ability to analyze cycles is an indispensable skill in the intelligent investor's toolkit. Recognizing which phase the market is currently in will help investors better prepare for potential future scenarios and seize attractive investment opportunities when the market undergoes irrational mania. Following the crowd's emotions has never been a successful investment formula. This is the reason behind Warren Buffett's famous saying, "Be greedy when others are fearful, and fearful when others are greedy." Frenzied stock buying and increasing margin leverage during euphoric markets or panic selling all assets during market crashes are the fastest paths to investment failure. Therefore, if investors cannot act independently of the market, it's best to invest passively in index funds. However, if investors choose active investing, the ability to separate themselves from the crowd is a prerequisite for sustainable success. The more euphoric the market, the more cautious intelligent investors must be in their investment decisions. The more panicked the market, the more daring intelligent investors must be to make bold decisions to seize attractive opportunities before they disappear. However, understanding what needs to be done is one thing, being able to do it is another entirely. Most practically, investing is more a game of psychology than of intellect. Although analytical ability plays a crucial role in investing, intelligent people are ultimately human and can easily be swayed by emotions like everyone else. If investing only required an IQ score, Nobel laureates would have all become billionaires by now. Even the brilliant physicist Isaac Newton was swept up by the crowd and participated in the South Sea bubble, ultimately losing all his accumulated wealth. Through this painful experience, Newton famously remarked, "I can calculate the motion of heavenly bodies, but not the madness of people." There are many uncertain factors in the investment world, but it seems that cycles are a rare exception. However, just because we know the market has been rising for a considerable period does not mean it must fall the next day. There is no certainty that a company overvalued now will experience a decline the following week. The cyclical nature is unchanging, but the timing of reversals and the intensity of each phase entirely depend on the market's behavior at the time it occurs. Investors can be certain that the market will fall after rising to high, and that it will recover after declining to long, but the exact timing of these reversals will always be a challenging question even for the best investors. As Howard Marks once shared, being right too soon is no different than being wrong. Investors might correctly identify that a bubble is inflating, but if they short sell too early, they cannot avoid losses. For example, some investors shorted the housing bubble from 2003 to 2008 too early and had to cut their losses because the bubble continued to inflate until 2008 before bursting. Were they wrong? They were not wrong about the market's direction, but they were wrong about the timing. Just because a bubble is inflating does not mean it cannot continue to inflate in the future. It only means the probability of the bubble bursting is increasing. However, the exact timing of the burst will always remain uncertain. You can accurately assess the current market situation, but if you decide to act too early, it is essentially equivalent to making a wrong decision. Intelligent investors understand the unchanging nature of market cycles, but they also understand that timing the market is always a dangerous gamble and certainly not for the faint-hearted. The market is riskiest when everyone agrees that risk does not exist, and the greatest opportunities arise when everyone refuses to participate in the market because they believe the risk is too high. Being intelligent alone is not enough. The ability to control one's emotions plays a more crucial role in investing. Isaac Newton's example is a typical case in point. Subjectively, the author believes that succeeding in investing is even harder than conducting scientific research. Cycles will always be a constant in the market, a rule proven by history through numerous phases of explosive growth and catastrophic collapses. For intelligent investors, the best profit opportunities always arise when most investors forget this rule.